We all love a bit of extra income, and if you are looking for a great source of extra income, cryptocurrency is the best thing for you. It might be the case that you do not have any sort of experience in trading and the stock market fails to interest you. If this is the case, you can always opt for cryptocurrency. The aim of this video series is to provide you with all sorts of info that can make cryptocurrency investing easier for you. Chapter 1: Basics of Cryptocurrency. Cryptocurrency is a system of online payment in which any kind of currency or cryptocurrency can be used. It can now be found globally. It is a decentralized form of currency that uses blockchain. How does cryptocurrency function? The overall exchange between real-world currencies and digital currency is done via a peer-to-peer network to save the transactions from fraud. It is necessary to process and validate every kind of transaction. So, if you want to invest in cryptocurrencies, such as Bitcoin, Ethereum, or Litecoin, it is always suggested to purchase the same from well-known retailers. What are the benefits of cryptocurrency? The primary benefit of cryptocurrency is that it is completely open source, similar to the internet. They can be transferred from one cryptocurrency to some other. It is safe from all kinds of government amendments or their interventions. It can be accessed from all over the world. Cryptocurrency is free from all kinds of transaction fees and taxes. In fact, there is no requirement for registration. Terminologies to keep in mind. Altcoins, it is a general name used to refer to cryptocurrencies other than Bitcoin. Bear market, in case you are sure that a cryptocurrency or market will show downward movement, it is said that you are bearish. Alt season, it is a period when altcoins get to see a huge rise in price. Bitcoin is the first and most popular cryptocurrency introduced by Satoshi Nakamoto in the year 2008. Bull market, it is a market where the trend is in the upward direction. You will be bullish when you have the belief that the market will move up. Blockchain technology, a decentralized database technology upon which the overall market of cryptocurrency is developed. Crypto, it is the shortened term for the word cryptocurrency. Exchange, a place where you can sell or purchase cryptocurrencies. The most popular exchanges are Binance and Coinbase. FUD, fear, uncertainty, and doubt, it generally leads to a decline in the prices of cryptocurrencies. FOMO, fear of missing out, it refers to participation in the market at the peak, and the concerned people lose out on lots of money. ICO, initial coin offering, it is a crowdfunding strategy used to bring new projects of cryptocurrency to the market. HODL, it is a term that refers to the long-term investors of crypto who come with the desire of making profits over several years. Limit order, a seller purchase order gets executed as the price of an asset attains a certain value that is specified within that order. Ledger Nano S, it is a kind of cold wallet that is used for the offline storage of cryptocurrencies. It is done for the prevention of hacks on the internet. Market order, it can be regarded as a kind of buy and sell order that is meant to execute instantly at the present market prices. Long, as an investor, you will have to get into the market at lower prices with the hope that the price will move up with time. Mooning refers to when the price of a cryptocurrency increases astronomically, somewhat like going to the moon. Mining, it can be regarded as a process that is used for the verification of blockchain transactions. Satoshi, it is regarded as 1/1,000,000th fraction of Bitcoin. Pump and dump, it is a strategy when someone purchases an asset at a lower price. When other people start purchasing it, they start selling the asset or dumping the asset. Satoshi Nakamoto, he is the publisher of the white paper that introduced Bitcoin to the market. Short, it refers to borrowing and quickly selling a cryptocurrency asset with the belief that the price will fall. Shitcoin, it is a crypto asset that is more or less of no worth. Generally, the project behind the currency is a huge scam. Stop limit order, it is an order that includes two prices, the stop price and the limit price. Stop loss order, it is a kind of order that gets executed automatically to cut down losses or to secure the profits you make. Whale, it indicates all those who tend to hold huge amounts of a certain cryptocurrency. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks. We all love a bit of extra income, and if you are looking for a great source of extra income, cryptocurrency is the best thing for you. It might be the case that you do not have any sort of experience in trading and the stock market fails to interest you. If this is the case, you can always opt for cryptocurrency. The aim of this video series is to provide you with all sorts of info that can make cryptocurrency investing easier for you. Chapter 1: Basics of Cryptocurrency. Cryptocurrency is a system of online payment in which any kind of currency or cryptocurrency can be used. It can now be found globally. It is a decentralized form of currency that uses blockchain. How does cryptocurrency function? The overall exchange between real-world currencies and digital currency is done via a peer-to-peer network to save the transactions from fraud. It is necessary to process and validate every kind of transaction. So, if you want to invest in cryptocurrencies, such as Bitcoin, Ethereum, or Litecoin, it is always suggested to purchase the same from well-known retailers. What are the benefits of cryptocurrency? The primary benefit of cryptocurrency is that it is completely open source, similar to the internet. They can be transferred from one cryptocurrency to some other. It is safe from all kinds of government amendments or their interventions. It can be accessed from all over the world. Cryptocurrency is free from all kinds of transaction fees and taxes. In fact, there is no requirement for registration. Terminologies to keep in mind. Altcoins, it is a general name used to refer to cryptocurrencies other than Bitcoin. Bear market, in case you are sure that a cryptocurrency or market will show downward movement, it is said that you are bearish. Alt season, it is a period when altcoins get to see a huge rise in price. Bitcoin. Bitcoin is the first and most popular cryptocurrency introduced by Satoshi Nakamoto in the year 2008. Bull market, it is a market where the trend is in the upward direction. You will be bullish when you have the belief that the market will move up. Blockchain technology, a decentralized database technology upon which the overall market of cryptocurrency is developed. Crypto, it is the shortened term for the word cryptocurrency. Exchange, a place where you can sell or purchase cryptocurrencies. The most popular exchanges are Binance and Coinbase. FUD, fear, uncertainty, and doubt, it generally leads to a decline in the prices of cryptocurrencies. FOMO, fear of missing out, it refers to participation in the market at the peak, and the concerned people lose out on lots of money. ICO, initial coin offering, it is a crowdfunding strategy used to bring new projects of cryptocurrency to the market. HODL, it is a term that refers to the long-term investors of crypto who come with the desire of making profits over several years. Limit order, a seller purchase order gets executed as the price of an asset attains a certain value that is specified within that order. Ledger Nano S, it is a kind of cold wallet that is used for the offline storage of cryptocurrencies. It is done for the prevention of hacks on the internet. Market order, it can be regarded as a kind of buy and sell order that is meant to execute instantly at the present market prices. Long, as an investor, you will have to get into the market at lower prices with the hope that the price will move up with time. Mooning refers to when the price of a cryptocurrency increases astronomically, somewhat like going to the moon. Mining, it can be regarded as a process that is used for the verification of blockchain transactions. Satoshi, it is regarded as 1/1,000,000th fraction of Bitcoin. Pump and dump, it is a strategy when someone purchases an asset at a lower price. When other people start purchasing it, they start selling the asset or dumping the asset. Satoshi Nakamoto, he is the publisher of the white paper that introduced Bitcoin to the market. Short, it refers to borrowing and quickly selling a cryptocurrency asset with the belief that the price will fall. Shitcoin, it is a crypto asset that is more or less of no worth. Generally, the project behind the currency is a huge scam. Stop limit order, it is an order that includes two prices, the stop price and the limit price. Stop loss order, it is a kind of order that gets executed automatically to cut down losses or to secure the profits you make. Whale, it indicates all those who tend to hold huge amounts of a certain cryptocurrency. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks.
Chapter 3: Cryptocurrency and its application. The majority of decentralized digital currencies, like Bitcoin, were developed for something. So there are various powerful usages. Here are some of the common applications of cryptocurrency. Low-cost fund transfers. For instance, the latest transaction of $99 million. Litecoin, LTC, took about 2.5 minutes to get processed. Also, it only costs $0.40 for the sender in the form of transaction fees. in case the same amount of money had to go through some traditional financial intermediary. The overall fees would have been much more. In fact, the transaction would have taken a considerable number of days to get completed. The low fees linked with transactions with digital currencies like Stellar, XLM, Bitcoin Cash, BCH, or Litecoin, LTC, make them superb systems of payments for international funds transfer. Get interests in Bitcoin and other cryptocurrencies using yield farming. There are various ways in which you can earn some steady interest from cryptocurrency. Famous examples include crypto staking and DeFi lending. Compared to the rates of interest that are offered by any traditional bank, lending a cryptocurrency to some reputable platform is a great option. However, you will have to keep in mind that such kind of lending is not at all free from risks. Also, it is not insured by any form of a government body. A censorship-resistant option to store wealth. While you might not think about your assets and bank accounts being frozen, the truth is that such a thing takes place more often than you can even realize. As such things take place, people might find themselves with little or zero access to cash. It is exactly where the most powerful and unique usage of cryptocurrency comes into play. Cryptocurrencies, such as Bitcoin, act as censorship-resistant, alternative storage of wealth that can only be accessed by the individual who possesses private keys to the wallet. So, no personal crypto wallet can be frozen by regulatory authorities. Invest in early-stage and innovative startups. The onset of token-based digital fundraising has permitted any person with an internet connection to be an investor in tech startups. Also, at the same time, it helps in providing new startups with the required seed capital. IPO and ICO are forms of fundraising that deliver startups with the opportunities to raise capital by selling out some new digital tokens to the early backers of the project. It is done in exchange for established cryptocurrencies like Ethereum, ETH, or Bitcoin, BTC. The development of cryptocurrency has helped in opening all such opportunities to a broader spectrum of investors. Making private transactions. There are various privacy-centric digital currencies like Zcash, ZEC, Monero, XMR, and Pix. Such currencies allow users to opt for anonymous financial transactions. It indicates that you can opt for financial transactions without explaining to your bank why you are sending a huge amount of money, what the fund source is, and who you are sending it to. Sending non-cash remittances. One of the great usages of cryptocurrencies is non-cash remittances. For instance, blockchain startup SureRemit allows its users to send non-cash remittances from all over the world to specific African nations. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. We will see you in the next chapter of cryptocurrency. Thanks. Chapter 4. Evolution of Cryptocurrency. It is said that cryptocurrency existed much before the first digital currency alternative was introduced. We will discuss the evolution of crypto in this section, and we'll also get to know some basic things that are necessary before someone starts investing. Before Bitcoin. In the early 1980s, a cryptographer named David Chaum from America invented a blinding algorithm. The majority of fundamental features that can now be found in cryptocurrency, like robust anonymity protection and decentralization, were included in a white paper by Y. Dai 15 years later. Y. Dai was an accomplished software engineer. The late 90s. Digital financial intermediaries with conventional models started their development during the late 1990s and early 2000s. Bitcoin was the first cryptocurrency that emerged during the late 2000s. It is one of the cryptocurrencies that is still used today. The first block of the Bitcoin network was mined by Nakamoto on 3 January 2009. The market starts to form, 2010 to 14. Although it was not of much worth yet, Bitcoin started to show its real-world value. In the year 2011, the price of Bitcoin rose to $1.06 right before getting back to 87 cents or less. The price of Bitcoin rose from 87 cents to $8.89. On 1 June, after Gawker published a story regarding the appeal of cryptocurrency in the community of online drug dealing, the Bitcoin price tripled within 1 week to $27. By September 2011, the value of Bitcoin came back to $4.77. It was in the month of October when Litecoin appeared in the market for the first time. Litecoin occupied the second position in the market. In 2013, on 19th November, the Bitcoin price reached $755 to crash down to $378 on that same day. By 30th November, the price was again at $1,163. The time of scams, 2014 to 16. In January 2014, the largest Bitcoin exchange of that time collapsed. The exchange declared bankruptcy while losing about 850,000 Bitcoin, although it is still not clear what happened exactly. Now, the security of exchanges is enhanced. Today, the traders of crypto are advised to opt for a software wallet so that they can store their cryptocurrencies safely. The period of 2016 to 18. The price of Bitcoin kept moving up steadily, rising from $434 in the year 2016 to $998 in 2017. 1 week after the upgrade in the month of August, Bitcoin traded at about $2,700. By 17th December, Bitcoin achieved its all-time high of being under $20,000. At the same time, a new project based on blockchain was gaining popularity in the crypto market. It was Ethereum. 2018 to present, Bitcoin failed to sustain its peak. By the end of 2018, Bitcoin dropped below $3,700 because of continued exchange hacks. But the prices moved up once again, and Bitcoin along with Ethereum have rebounded in the present. Consider the following before you start. There are many things that are necessary to complete a transaction. Some of them are a crypto exchange account, private identity papers if you opt for a KYC platform, a steady internet connection, and also a mode of payment for carrying out transactions. Experts always suggest opting for a private wallet with no link to your trading account. The payment modes that are accepted on this road are debit cards, bank accounts, and credit cards. Here are some of the steps you must follow to get started with cryptocurrency. First step, deciding on a trading platform. There are various types of crypto exchanges that can be found today. Various exchanges permit the users to stay anonymous. Such platforms do not ask for private info about the users. But for the time being, the famous exchanges are not decentralized, and also there is no need for KYC. Kraken, Coinbase, Binance US, and Gemini are some of the popular exchanges for cryptocurrencies that function in the US. As you set up an exchange account, it is necessary to follow safe internet habits at every step. For instance, opt for two-factor authentication and also opt for long and complex passwords. Second step, integration of exchange with a mode of payment. As you fix your mind on an exchange, the following step is to collect all your non-public papers. The pictures might include an image of your driving license or social security number. It also includes info about your company and financial sources, relying on the exchange. The majority of exchanges will let you link your account to a financial institution without any sort of delay. Or else, you can opt for your credit or debit card to take part in the exchange. Although cryptocurrency is legal in the US, certain banking firms might not allow you to opt for deposits to crypto-based exchanges or websites. Third step, making a purchase order. You might now acquire any cryptocurrency that you want to. In recent years, crypto exchanges have gained popularity and have also grown to be more accessible. As you decide on an exchange and successfully attach a billing method to your crypto account, you are all set to start your journey. Fourth step, ensuring storage. Cryptocurrency wallets are a safe place for the storage of virtual property in a secured way. You will also be able to store your capital away from the exchanges while reducing the risk of your account being hacked. There are two types of wallets, hot and cold. Hot wallets are referred to as online wallets. Phones and computer systems are some of the examples of internet-based devices that can function in the form of hot wallets. As such wallets are based on the internet, they might lead to the vulnerability of all your money. The best way of describing a cold wallet is to think of it as a pocket that has no link to the internet. It comes with reduced risks of getting hacked. You will have to decide which wallet you want to opt for, depending on your need and security of money. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks. Chapter 5. Pros and Cons of Cryptocurrency. A huge number of people, specifically of younger generations, have become interested in cryptocurrencies. On the other hand, there are many people who have little or zero ideas about the crypto market, and so they haven't paid any attention. The unparalleled transparency of cryptocurrency is one of the major reasons digital currency offers more accountability and societal change. Due to this, Bitcoin has turned out to be one of the most popular cryptocurrencies worldwide. You can buy or spend anywhere and anytime you want to. Everything can be managed from your mobile device. So you have got the chance to access your finances instantly and opt for real-time decisions. But the overall functioning of the crypto market can turn out to be challenging and complicated to comprehend. So before you start investing in cryptocurrency, it is necessary to be aware of the probable pros and cons. Pros of cryptocurrency. Here are some of the pros of cryptocurrency. Number 1. User autonomy. As a user, you can always control the way in which you want to spend your money. So it can be said that digital currencies provide users with more degree of autonomy over their own capital compared to traditional currencies. Number 2. Discretion. Cryptocurrency purchases are discreet. Crypto transactions are not entirely anonymous or untraceable. But in comparison to the traditional forms of payment, cryptocurrencies are less linked with personal identity. Number 3. Elimination of bank fees. It is a standard practice of cryptocurrency exchanges to take taker and maker fees, besides the occasional deposit and withdrawal fees. There are various kinds of traditional banking fees. Some examples include account maintenance or minimum balance fees. Number 4. Focus on peer-to-peer. What it indicates is that users are not required to wait for any approval from external authority sources. So you can receive and send payments from or to anyone on the crypto network without the need to deal with an intermediary. Number 5. Low transaction fees for international payments. Because there is no involvement of intermediary institutions or government bodies. Such kind of practice helps in keeping the cost of transactions quite low. Number 6. Accessibility. Cryptocurrency is available to all those who still have no access to traditional banking systems and credit cards or any other system of payment. Number 7. Mobile payments. As long as crypto users have access to the internet, they can keep paying using their coins in the same way as online payment systems work. Such a feature is quite convenient as it indicates that purchasers using cryptocurrency will never need to travel to a bank or store for something. Cons of cryptocurrency. We have just now discussed the pros or advantages of cryptocurrencies. So you will need to get to know and understand the drawbacks and obstacles of the crypto market that might reduce the speed of mainstream adoption of such a technology. Number 1. Scalability. The most significant thing of concern with the crypto market is the issues linked with scaling. Until the technology infrastructure is scaled in a massive way for the improvement of transaction speeds greatly, cryptocurrencies might not be able to fight on the same level as the big players of payment processing. It is tough and complex to evolve the technology of crypto in a seamless way. Number 2. Price volatility and lack of inherent value. The price volatility that can be found in the crypto market, along with the lack of inherent value, is a genuine issue. Confidence on the part of consumers should increase as cryptocurrencies get adopted, thus reducing volatility. Number 3. Issues of cybersecurity. As cryptocurrency is more or less a digital technology, it will always be subject to hackers. Cybersecurity breaches are quite common as it is digital technology. It has happened a couple of times, with security issues costing the investors of crypto millions of dollars. There are major players of cryptocurrency who are dealing with the issue directly. They are trying to do so by the implementation of improved cybersecurity measures that are much better than the ones used by traditional banking systems. Number 4. Regulations. Currently, governmental entities do not supervise or regulate cryptocurrencies, like the United States Federal Reserve or other central banks. However, China has made some moves in such a direction. Even when the previously mentioned concerns are addressed by the technology, there will still be a heightened risk of investing in the crypto market until it gets adopted formally by the federal government. It is necessary to get regulated. The overall future of the crypto market is still not certain, but there are lots of potentials. Also, the critics of cryptocurrency can see lots of risks. It is quite understandable why experienced investors are trying to be cautious of the same. There are also people who believe that cryptocurrencies are here to stay. It is because crypto technology provides all those advantages that we all want in a currency. We want decentralization, flexibility, and transparency. All we can do is just wait and find out how everything progresses with time. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks for watching.
Chapter 6. Safety and Security. It might not be safe all the time to invest in digital currencies. So before you decide to step into the crypto market, you need to have proper knowledge regarding trading cryptocurrency. Is crypto secure? Because of the complexity, it might be hard for hackers to get through, making the technology quite secure. You can make your cryptocurrencies more secure with the help of certain measures, which we will talk about later in this section. You are required to be well aware of the security standards of cryptocurrency. What are crypto security standards? It is a set of security requirements for all the systems that are used for cryptocurrency. It helps in managing and standardizing the techniques. It can be regarded as 10-step security that is put in 3 levels. Here are the steps that the majority of blockchain organizations and companies follow. 1. Wallet creation. 2. Seed or key generation. 3. Key usage. 4. Key storage. 5. Key holder revoke or grant policy and procedures. 6. Key compromise policy. 7. Proof of reserve. 8. Log audits. 9. Data sanitization policy. 10. Third-party audits. Protecting your investments. The hacking of crypto is on the rise. The hacking economics suggest that attackers will keep gravitating in the direction of digital currencies as they keep increasing in value. Here are some tips that can help you to protect your crypto investments. Number 1. Taking a hybrid approach to the security of the digital wallet. Physical or offline wallets need to be used for storing the majority of your cryptocurrencies while storing only a small amount in online wallets. Physical wallets are required to be stored in a secured place like a safety deposit box. Number 2. 2 strong passwords are the best option. Ensure that you do not use the same passwords across any account. The easiest and quickest way of securing your wallets is to opt for tried and tested tactics of security. You can try to constrict your overall exposure by using some unique password, with password rotation and 2-factor security authentication turned on. Number 3. Opt for reputable crypto exchanges, wallets, mobile apps, and brokerages. Before deciding which platform to opt for, new investors should always try to research the security features of all the platforms. Like a requirement for multi-factor authentication, air-gapped devices that are kept offline at the time of storing cryptocurrency, and SSL or TLS encryption. Opting for more than one platform of cryptocurrency can be a safe option if you use complex and different passwords for all the platforms. Number 4. Protection from mobile phishing. Malicious hackers get motivated to target the investors with mobile phishing campaigns so that they can steal the login credentials. So always opt for antivirus software to safeguard your computers and mobile devices. Number 5. Being aware of ways in which your wallet is utilized in transactions. Any kind of cryptocurrency wallet is nothing more than a combination of code and data. Ensure that the networks or systems are safe in case you use them to make transactions besides maintaining physical protection. Number 6. Understanding various processes and methods for the protection of digital currency. In case you get hacked, the chances of recovering the lost assets are 0. you will have to learn about the 3 essential components: secret key protection, crypto miner malware protection, and recovery seed protection. Number 7. Stay away from sharing the keys. Secret keys are used to verify that a person receiving or sending digital currencies owns the wallet in use. Such private or secret keys are not meant to be shared with anyone. One of the best ways of storing private keys is to use cold storage. It indicates printing your key followed by discarding all sorts of digital signs of the same. Number 8. Do not use wallets hosted by the providers. Some of the other ways to store your cryptocurrencies are wallets that get hosted on desktops or laptops, and also wallets by providers. Keep in mind that the wallets from the providers are one of the worst choices. It is due to the fact that you will let them have the private keys on the private servers, where you will have no control. That's all for this one. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks for watching. See you in the next one.
How to create ETF investment portfolios. If you stay with me until the end of the video, I will show you portfolio ideas based on your age. To correctly determine what percentage of equities place within portfolios, we must take into consideration 2 factors: fundamentals, 1. Your risk profile, 2. The time horizon assigned to each investment objective. Let's delve into these 2 factors. 1. Your risk profile. Your risk profile is determined by 3 closely related components: risk need, risk capacity, risk tolerance, risk need. Your need for risk identifies how much risk equals how much equity hold you need to take on in order to achieve a given investment. Your need for risk clearly depends on how far you are still distant from reaching the target equity you have assigned to a given goal. The farther you are from the target, in terms of money and time, the more need you have for return to achieve it. In this case, you will have to favor the equity component. Conversely, if you have already allocated a large amount of capital to a goal and you are only close to reaching the amount you set yourself, you need to reduce the equity component in favor of the bond component because you have a high need for return. Risk capacity. It is the ability to financially withstand a loss or a return less favorable than you had budgeted. Risk capacity, in other words, has to do with your soundness, financial strength, and depends on the level of your income, the total value of your assets, and the time horizon of your investment goals. Risk capacity, therefore, aims to answer this question: how much risk can you afford to take on in light of your financial situation? It seems obvious to me that an employee earning €1,500 a month, who has 2 children, and modest financial capital, can take on far less risk than a retired millionaire bachelor. Risk tolerance. It is the psychological predisposition to take risks. Everyone is different in personality, experience, education, and social environment. It is, therefore, quite normal to have different risk tolerances. And it is equally normal for risk tolerance to change with the passage of time. Personal, family, and professional situations change, and with them your risk tolerance will certainly change as well. Identifying your risk tolerance is not easy. We are not talking about objective, measurable financial parameters for which you set a formula and come up with your risk tolerance. It is something you can only understand with practice and can be trained, all the more so if you have understood that in order to achieve a return in the long run, it is desirable and necessary to invest in stocks. A good starting point for determining this is to ask yourself, what is the threshold below which a major stock decline can take away my sleep and make my life worse? Minus 15%? Minus 20%? Minus 30%? Minus 40%? Below is a table that gives you some rough indication of how much stock to hold based on the volatility you think you can bear. Maximum volatility you can handle. Maximum percentage of stock recommended, minus 5. 20%, minus 15, 40%, minus 25, 60%, minus 35, 80%. The time horizon assigned to the investment objective. The asset allocation must also change as the time you have available to achieve the goal. Why? Because market risk, that's the risk that you cannot can be eliminated by diversification, is reduced, to the point of being nullified, at least from a historical and statistical point of view, by the factor of time. The longer and more distant the time horizon, the more you can afford to take a good deal of market risk by investing more in equities. Conversely, if the time horizon is short and close in time, you will have to correspondingly reduce your exposure on the equity asset class, favoring the more defensive component, namely bonds. The money you need 15 years from now for your child to study at a prestigious university must, therefore, necessarily be invested in a riskier way than the money you need in 5 years to start your own company. Again, we give you some broad guidelines on how much equity to hold based on the time you have to reach your investment goal. One last important concept about asset allocation. The difference between the success or failure of your financial plan, and thus the achievement or otherwise of your investment goals, will not be determined by choosing the perfect asset allocation. Unfortunately, the ideal portfolio can only be identified after the fact. We can certainly know what we should have done in the past, but not what will happen in the future. What we can do, however, is 1. Define the percentage of equities based on the time horizon assigned to the target and our risk profile. 2. Reduce risk by watering down the equity whiskey with the bond component. 3. Mixing the asset classes we selected to have the same level of risk in all possible economic seasons. Indeed, while it is true that the most important decision is to decide how much capital to allocate to the equity component, it is equally true that in the portfolios we have included 2 additional asset classes, gold and commodities, which perform a decorrelation function. So let us look at this second cornerstone principle on which the portfolios are built. Composition of portfolios, asset allocation, the economy, and therefore market risk, goes through various phases that alternate between each other and go to make up the so-called economic cycles. Each economic phase is characterized by a peculiar combination of these 4 conditions: 1. Inflation, 2. Deflation, 3. Economic growth, 4. Economic slowdown. It follows that there are basically 4 economic seasons that alternate cyclically. 1. Growth phase, given by the combination of economic growth and deflation. 2. Expansion phase, given by economic growth and inflation. 3. Recession phase, given by economic slowdown and deflation. 4. Depression phase, given by economic slowdown and inflation. During each economic season, there are asset classes that perform well and asset classes that perform worse. Some perform well during the growth phase, and poorly during the recession, others that perform well during the depression phase, and poorly during the expansion. Growth, stocks, commodities. Expansion and inflation, stocks, gold, inflation-linked bonds. Recession, gold, safe haven currencies, short-term bonds. Depression, liquidity, short-term bond. This is because, as economic seasons change, money is not burned, but will simply flow from one asset class to another. The problem is that, unlike the stable cycle of seasons in nature, the seasons' economy do not follow one another in a set order. We cannot know what the next economic season will be. Exactly the same way we cannot know which asset will do better in the future. If I knew, I would put all or most of my eggs in that basket. But it doesn't work that way. So the goal must be to build robust portfolios that perform well in any economic scenario and that keeps the amount of risk in all possible economic, expansion, contraction, and monetary, inflation, deflation. Portfolios that can hold their own when stock markets are plunging and ensure profits when markets are rising. All-season or evergreen investment portfolios that contain within them all the major asset classes, balanced in the right proportions. You have to build a strategic asset allocation on the assumption that you don't know what the future holds. Cite Ray Dalio, and this is only possible by including within portfolios asset classes that are decorrelated to each other, such as precisely stocks, bonds, gold and commodities. Commodities. Warning: building portfolios that perform well under any scenario. Economic scenario does not mean that you will not experience downturns during your career as an investor. But it does mean averting the risk faced by all investors who invest thinking they can get in and out by anticipating markets, namely the ruin risk. It will also be the right portfolios that will enable you to achieve your investment goals and avoid going astray when the financial markets will be stormy. The Strategic Asset Allocation of Portfolios 2022-23. Portfolios, Asset Allocation, 20 by 80, 40 by 60, 60 by 40, 80 by 20. Stocks, 20, 40, 60, 80. Bonds, 70, 50, 30, 10. Alternatives, 10, 10, 10, 10. Recommended time horizon, 3 to 5 anni, 6 to 7 anni, 8 to 9 anni, 10 anni plus. What is the optimal allocation between stocks and bonds in a portfolio? There can be no single answer, but perhaps there is a simple and practical rule to follow. Jack Bogle, one of the best investors of all time, suggests that the fraction of stocks should be reduced as the age of the saver increases. In fact, at 20, the investment strategy should be very different from what one assumes at 60. So if I were 40, I would do this portfolio asset allocation. Portfolio 60-40. Stocks, world stock, 30%. Stocks, Europe stock, 15%. Stocks, emerging stock, 15%. Bonds, U.S. government obligation short-term, 10%. Bonds, obligation government Europe short-term, 10%. Bonds, obligation government Europe inflation, 10%. Alternatives, commodities, 5%. Alternatives, ORO, 5%. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks.
Apple is the new market analysis. Apple shares in recent years have had impressive and steady growth over time. Just think that in 2003 the value of a single share was about $1. If we had bought Apple shares at that time with an investment of €5,000, today we will have almost €1,000,000. Really impressive numbers if we think only of the initial investment of €5,000. Rather than thinking about Apple shares, we should think about the Apple product. Now we don't know if you own an iPhone or at least an Apple product, but we can assure you that once you have tried one of their devices, it will be almost impossible to go back. Apple is sticky, as even the big investor and shareholder Warren Buffett put it. Here are his words: once you use the Apple ecosystem, you're very stuck, at least psychologically and mentally, to the product you're using. The iPhone is a very sticky product. There is also to take into account the consumer franchise that this company has, thanks above all to its strong ecosystem. This is demonstrated by the queues of hours or days waiting for the opening of Apple stores to buy its new products. In addition, Apple in recent years has always grown by increasing its profits and showing no signs of sagging. In general terms, Apple stands out for its excellent financial health and enjoys a very strong investment capacity, which is promising for its future and for its ability to innovate more and more to maintain an interesting positioning. From a historical point of view, the Apple Group has always published results beyond expectations, which proves to be extremely reassuring for investors. Last but not least, Apple as a company has an impressive markup on products sold. More precisely, Apple counts among the companies that have margin levels among the highest in the rating thanks to a type of activity that is known to be very profitable and an excellent mastery of production costs. It is no coincidence that for several years Apple has been distributing very high dividends to its shareholders, who are also in continuous and constant growth. Apple is one of the most innovative and healthy companies that can be found in the stock market. If you think that the sale of smartphones is their only income, you are mistaken. In fact, only 55% of its turnover comes from the sale of smartphones. The rest comes from 1. Music media, iPod and iPad, and related accessories. 2. MacBook and iMac computers. 3. Peripheral equipment such as screens, storage systems, printers, cameras, memory cards or servers. 4. Apple Music, Apple TV and Apple Store, where on the latter Apple receives a commission of 30% for each purchase in the app and 15% for recurring payments. This is one of the fastest growing services. Apple's stock has recently hit its all-time highs as the market capitalization approaches $3 trillion, but above all, because the main benchmark indices from the beginning of the year to date are recording a loss of more than 10%. A general reversal of the prices of most American shares. Most investors do not buy Apple for dividend, however, it yields 0.5% and the dividend has been increased for each of the last 9 years. In addition, the payout ratio is only 15%, so the dividend is extraordinarily safe. This, however, is not all. Apple also returns capital to shareholders through share buybacks. Share buybacks occur when a company buys its shares on the open market, thereby reducing the number of shares available. This means that each action is worth a larger slice of the cake. In fiscal 2021 alone, Apple bought back more than $85.5 billion of its shares, or nearly 3% of its total market capitalization. Apple had an excellent fiscal year in 2021, with revenues up 33% to $365 billion. In addition, investors expect the release of Apple's augmented reality AR and virtual reality VR glasses, which are said to hit the market in 2022. This could create a generous new revenue stream for this behemoth. Financial data. Over the past 5 years, Apple has increased its revenue from $229.23 billion in 2017 to $365.82 billion in 2021. Up by about 60%. Net income increased from $48.35 billion in 2017 to $94.68 billion in 2021. Growing by almost 100%. Apple shares are currently 12.52% below its all-time highs with a PE of 28.36. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks.
Alibaba Group, NYSE, BABA, Stock Analysis. The Alibaba Group is a privately held Chinese company with many companies primarily engaged in e-commerce. The market in which the group primarily operates in China, with sales exceeding the sum of sales created by its two main competitors, Amazon and eBay. Alibaba was founded in 1999 by Chinese entrepreneur Jack Ma and is headquartered in Hangzhou. Alibaba Group's business areas. Alibaba.com. It is an e-commerce marketplace that allows manufacturing companies to connect with distributors and buyers worldwide. The site is in English and is designed for the international market. It administers transactions between traders in more than 240 countries. 1688.com. It is an e-commerce site dedicated to the Chinese domestic market. AliExpress.com. The e-commerce platform aims at small businesses to enable even modest-sized companies to purchase moderate quantities of goods at wholesale prices. Alipay. Since 2004, Alibaba has had a standalone electronic payment platform similar to PayPal. Its strength lies in the guaranteed down payment service, which allows the customer to verify the products purchased before confirming the payment. A measure made necessary by the lack of consumer protection regulations in China. Alipay uses primary international payment circuits, Visa, MasterCard etc. We are talking about financial agreements with more than 65 institutions. Through Alipay, half of all economic transactions in China are now carried out. Auto, Navi. It is a company that provides land mapping services. It has developed a map, an app that enables satellite navigation. Taobao. Taobao.com is a retail marketplace operating mainly in Chinese-speaking regions. Through its platform, small businesses can have an online storefront and connect with millions of potential customers. In 2013, Taobao.com was among the world's top 10 most visited websites. Email. A contracted form of Taobao Mall, it is a commercial buying and selling platform between manufacturers and distributors. It operates mainly in Chinese-speaking markets but is also open to international manufacturers. Financial data. Analyzing the income statement, we see a perfect trend in turnover, growing steadily year on year, although margins and profits are declining, especially in the last year. Overall, the annual profit growth rate over 10 years is more than 20%. Other interesting data from Alibaba Group Holdings Limited ADR, NYSE, BABA. Free cash flow, $14.1 billion, is equivalent to $5.32 per share. Considering the current price, it equals an 8.4% return, but we are talking about the last year, which was numerically one of the weakest in the recent period. The valuation of the stock, Market cap 167 billion, also raises a smile if we think, for example, that between cash and short-term investments alone, Alibaba Group Holdings Limited ADR, NYSE, BABA, has something like 72 billion. I will turn it around for you in a more understandable way. The stock is worth $63.15, but of this $27 is practically cash per share. Finally, even at the balance and asset stability level, the ratio of current assets to current liabilities is greater than 1, and the percentage of debt to capital is less than 1. Why buy Alibaba stock? Alibaba is in a leading position in the distribution of goods in China. Therefore, agreements with large multinational corporations that operate globally, and would like to position their products in China, could enhance Alibaba's growth. In addition, if Alibaba invested more in other international markets, its trade weight would increase considerably. We had a step in this direction in early 2017 when Alibaba agreed with the Italian cargo aircraft company SW to connect with the Montichiari, Brescia, airport. This choice will bring the Chinese e-commerce giant closer to Italy and Europe. This transaction shows us that the geographic expansion of its business is part of Alibaba's strategic plan. The stock is back to its 2015 to 2016 lows, down more than 80% from its 2021 highs. Currently, the tensions seem to be easing, as harming Alibaba significantly would run counter to the CCP's goals of making China the world's largest economy and gaining global influence. Alibaba plays an important role in both cases. It owns the world's largest e-commerce marketplace, with a gross merchandise volume of more than $1 trillion a year, and is a significant partner for global brands such as Nike and Starbucks. Harming Alibaba would make China less attractive to international and multinational companies. The government is trying to avoid a further backlash after many US companies moved manufacturing operations out of China following the previous trade war. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks.
Adobe is the new market analysis. Adobe is an American software house headquartered in San Jose, California. It is best known for its video and digital graphics products. While Salesforce.com, with its customer relationship management software, is often cited as the top competitor in the software as a service (SaaS) domain, Adobe in its industry has also led the move to the cloud for most of a decade, providing well-known creative design applications and document collaboration tools, including Photoshop and Adobe Acrobat. As a $300 billion company, you might think Adobe's best days are gone. However, this business still has a few tricks up its sleeve that should help drive growth for long-term investors. This digital software giant has taken a more aggressive approach to acquisitions, recently acquiring Frame.io, a leading, cloud-based, video collaboration platform. Frame.io has over 1 million active users in numerous global companies, which aligns well with Adobe's mission to change the world through digital experiences. While the acquisitions are interesting, let's not forget how strong Adobe's core innovation funnel also is. Adobe has continuously announced new additions to its most popular platforms, including critical developments, such as payment services via Adobe Commerce, that expand its business into new profitable markets. The Adobe Experience Cloud product is perhaps the most striking example of this value proposition. This subscription service is the fastest growing segment within Adobe, a feat that's even more impressive if you fit that growth into the context of a pandemic for its legacy creative offerings. In addition, in Adobe's last quarter, management announced the company's record revenue level of just under $4 billion, with growth of more than 20% year over year. This revenue is not limited to profits, but is maximized by Adobe's aggressive share buyback program. The company announced that its board of directors has approved a new share repurchase authority, granting the company additional permission to buy back up to $15 billion of common stock by fiscal 2024. This combination of business performance has created exceptional results in the market. Adobe has a compound annual growth rate of 5-year revenues of more than 20%, along with net profit and free cash flow growth rates of 43% and 34%, respectively, over the same time period. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks.
Nike is our new market analysis. Nike is a U.S. multinational that manufactures footwear, clothing, and sports accessories. Created in 1971, it is headquartered in Beaverton, United States. the market has seen investors walk on thin ice in recent months. With record levels of inflation, rising interest rates, and concerns involving Russia and Ukraine, growth stocks have come under enormous pressure lately. It is very common for investors to switch from speculative investments to safer assets during times of uncertainty, which is exactly what is happening today. It would not be foolish to consider for the moment to turn to more established companies. Companies like Nike offer investors much-needed security in today's precarious economic environment. Nike, which is perhaps the most recognizable retail brand in the world, possesses many favorable features for a long-term investment portfolio. Although there are many reasons to appreciate the major retailer, here are 3 valid reasons to buy Nike today and keep it for the next 5-10 years. 1. A world-class retail moat. Nike's moat in the sportswear market is unrivaled. In 2021, Nike generated sales of $44.5 billion, compared to major competitors Lululemon Athletica, Adidas, and Under Armour, which reported revenues of $6.3 billion, $21.2 billion, and $5.7 billion respectively. The company dominates nearly 50% of the U.S. sports footwear market and about a third of the entire sportswear industry. With the forecast that the sportswear market will generate $270 billion in annual sales by 2028, Nike is in a prime position to sustain solid growth in the years to come. In addition, the list of sponsors of the company's athletes is unrivaled. From Michael Jordan, LeBron James, and Serena Williams to Tiger Woods, Rafael Nadal, and Cristiano Ronaldo, Nike comes with a portfolio of the world's most influential athletic figures. Pair that with the company's Just Do It slogan, and it's safe to say that Nike's economic moat is as durable as few companies in the world. 2. Consistent numbers day after day. Even when investors expect the worst, Nike seems to be delivering great results. The company has recently fought several obstacles related to the closure of factories due to the pandemic and sales growth in the greater region of China. Even so, Nike still managed to report revenue of $10.9 billion and earnings per share of $0.87 per share in its most recent quarter, beating consensus estimates of 2.47% and 21%, respectively. The results surprised many investors as Nike's sales in China, which account for a solid chunk of its business, fell 8% in the quarter. Nike's beauty is its broad and diverse global portfolio. This allows the company to succeed over and over again, even if some segments of the company experience substandard performance. Especially in today's volatile market, investors should be very pleased with Nike's ability to meet challenges and deliver great results on the financial front. 3. Perpetual innovation. One of Nike's underrated strengths is its ability to evolve with the consumer over time. The company is not afraid to challenge the status quo and think outside the box. In a world that is becoming increasingly electronic, Nike's digital sales continue to skyrocket. In the third quarter, Nike brand digital sales increased 22% year-over-year, largely driven by a 33% increase in the North America region. The Nike mobile app also grew more than 50% in the third quarter, surpassing Nike.com as the company's highest share of digital demand. Nike continues to break barriers and enter new markets, such as the metaverse. In late 2021, the company bought RTFKT Studios, a non-fungible token (NFT) company focused on creating virtual shoes. Although the NFT market is still in its infancy, the acquisition shows that Nike is perfectly willing to adapt to consumer demands and experiment with new cutting-edge technologies. Ultimately, in today's market, Nike is a great investment choice. The sportswear giant has seen its share price depreciate by 35.36% since the beginning of the year, and as a result, although it cannot be said that the stock is strongly discounted, it is still cheap. Today, Nike is trading at 28.13 times earnings, representing a 34% discount to the multiple of 43 in the 5-year average price-to-earnings ratio.
PayPal is our new market analysis. The shift from cash to digital forms of payment is a powerful global megatrend. As a leader in digital money transfers and payment processing, PayPal Holdings is uniquely positioned to capitalize on this trend and deliver fortunes to its shareholders along the way. Consumers love PayPal's digital payments network because it makes online purchases easier, faster, and safer. These features also help merchants appreciate it, who tend to see their sales conversion rates improve when they offer PayPal as a payment option on their websites. Thanks in part to these benefits, PayPal's active user and merchant accounts increased by more than 392 million and 28 million, respectively. PayPal's revenue is mainly driven by the total volume of payments, TPVs, flowing through its platform. The win-win scenario that PayPal has created for both consumers and businesses and the resulting network effects should continue to increase TPV thanks to the arrival of new users and merchants. In addition, as a neutral payment processor, PayPal is not tied to any single e-commerce operation. Users can enter their payment information into PayPal's secure system once and instantly access a world of buying opportunities. In addition, PayPal has wisely chosen to partner with payment service providers around the world, including Mercado Libre in South America and Alibaba in China. Rather than trying to compete with these international heavyweights, PayPal works with them to provide new services, such as cross-border payments. In this way, everyone benefits. For all these reasons, PayPal's revenue and profits are set to rise steadily as more transactions flow through its platform over the next few years. What makes PayPal a good investment? At its recent Investor Day presentation, management set a goal of increasing PayPal's account base to 750 million by 2025. As the company strives to reach its long-term goal of 1 billion users making transactions per day. With fewer than 400 million users today, PayPal remains at the beginning of its growth cycle. Venmo will be a key factor for growth. PayPal's popular peer-to-peer payments app is expanding rapidly. Venmo processed approximately $51 billion in TPV in the first quarter, an increase of 63% year-over-year. Yet PayPal has just started monetizing Venmo. New services, such as cryptocurrency trading, should help fuel Venmo's revenue and profit growth. As PayPal expands its business, its profit margins are expected to expand over time. Year to date, PayPal has experienced impressive average growth of 25%, while its operating income has risen by 84%. Simply put, PayPal is already a money-generating machine. In addition, PayPal has an available liquidity of more than $4.79 billion. This gives PayPal a lot of money to invest in new products and initiatives, as well as acquisitions that create value. All in all, PayPal predicts a future where it serves as an all-in-one, super application for its customers. It aims to complement its existing payment processing and money transfer services with a number of new financial solutions, high-yield savings accounts, investment tools in stocks and cryptocurrencies, budgeting and bill payment services, along with an ever-expanding range of new applications. Each of these services could help strengthen the others, thus making the PayPal platform more valuable and more adherent. The data collected by these services could also help inform PayPal's product development and improvement efforts. Financial return. In 2020, revenue increased by 20.72% compared to the previous year to $21.45 billion. Net income increased by 70.88% to $4.2 billion. Risks and how PayPal could be left behind. Competition is fierce in the payments sector. Although PayPal's scale provides advantages over its smaller rivals, it must remain at the forefront of innovation and be willing to adapt to changing consumer preferences if it is to maintain its leadership position. The premium valuation of PayPal also poses a risk to investors. Its shares are currently trading about 50 times its projected earnings in 2021 and 43 times its EPS estimates for 2022. Any material slowdown in total payout volume or other key growth metrics in PayPal could force investors to readjust their expectations and lead to a contraction in the stock. Yet, we are not overly concerned about this. We consider PayPal an elite company with huge long-term growth prospects and are willing to pay a reasonable premium for quality. According to the news of the main newspapers, in particular Bloomberg News, PayPal wants Pinterest and has put on the plate an offer of about $39 billion for the acquisition of Pinterest. However, several shareholders of PayPal have not been enthusiastic about the possible acquisition, and this has led the stock to a reversal of about 10%. Pinterest shares, on the other hand, rose nearly 13% yesterday after the news broke. Today, however, they have decreased by 2% for fear that the agreement may be in danger. In any case, we believe that this reversal is not in the least related to the performance of the company or to a possible regression. PayPal is, and will remain for a long time, one of the best companies in the world in the fintech space, with or without Pinterest. The stock is currently at minus 20.27% from its all-time highs. The reversal had yesterday and today has brought the stock to an entry price. Not discounted, but reasonable, if the intent will be to keep it for the medium-long term. Ultimately, PayPal is a leader in an increasingly important industry, with partnerships, cash flow and innovative culture to keep it at the top for many years to come. Investors buying stocks today should be well rewarded as PayPal realizes its fantastic growth potential and its place in our financial lives. I hope you liked the video. In that case, I invite you to subscribe and put a like to support the channel. Thanks.